I wanted to take the time to talk about the foreign earned income exclusion and kind of just go through explaining it and really read more. Um, the foreign earned income exclusion, without even getting into this and reading this, the idea is that if a U.S. individual lives outside, when I say U.S. individual, I mean citizen. When a citizen lives outside the United States and stays outside the United States for 330 days, that being one of the tests, 330 days outside the USA or more, they qualify for the foreign earned income exclusion. And what the foreign earned income exclusion is a exclusion, kind of like a deduction, but more importantly, an exclusion where you can exclude a certain amount of income generated against your taxes. So, for example, if let's say you made $200,000 living in the USA, and you live in New York City, for example, you would be taxed on that income. You would be taxed city tax, state tax, federal tax. You'd be taxed, right? But if you lived outside the USA for the year, let's say you came back to America for 30 days, right? You have up to, I believe, 35 days to stay inside of America, but let's say you were at 30 days, then your tax would be reduced, right? The 200,000 minus the 120. Now, there's some stipulations, there's some things to get into. It's not as simple as that, but basically, if you have been outside the USA, living outside the USA, and you're a citizen for 330 days, you have the benefit of essentially excluding some level of income, and pretty significant. So let's kind of read through it. I'll explain it a little bit more, but there are some things that matter. From my understanding, and we're about to clarify everything today, from my understanding, the income increases every year. We'll actually see here. So I don't know what they mentioned for 2024. I don't think that information came out yet, or maybe it did. Who knows? But my guess is somewhere around 126,000 is the number for 2024. For 2023 was 120, 112 for 2022, 108 for 2021, 107,600 for 2020. So I'm thinking about 126, 124, somewhere around there for 2023. But essentially, let's read it together. Let's understand it. Let's break it down. And if you have any questions, I'm happy to answer them in the comments down below. All right. So it says, if you meet certain requirements, you may qualify for the foreign earned income exclusion. The foreign housing exclusion and or the foreign housing deduction. So notice what it says here. If you live outside the U.S., you may qualify for the foreign earned income exclusion. That's one. And then either the foreign housing exclusion or the foreign housing deduction. There's actually a significant difference between the two, okay? And we'll talk about that later towards the end. It says you must have foreign earned income. So they actually have a definition of what foreign earned income is. And so we can read here what foreign earned income is. It says the foreign earned income exclusion. The foreign housing exclusion, the foreign deduction are based on a foreign earned income. Is there a definition here of foreign earned income? The whole thing is pretty much. It says earned income is to pay for personal services performed such as wages, salaries, or personal fees. The list classifies many types of income in three categories. So here we have earned income, unearned income, and variable income. So notice this deduction, the foreign earned income, is on earned income. It's not on variable income, at least not that I know of. I mean, we could see here because it says different classifications. It says unearned income, earned income, and variable income. So, for example, unearned income, alimony, pensions, interest, dividends. Here we have salary, wages, commissions, capital gains, unearned income. So let's see how this thing works. So notice how it says here interest or capital gains. So let's say I'm trading stocks, right? And that's the only way I make money. Well, that's considered capital gains. So technically it's unearned income. which means I didn't go out there and necessarily earn it. I might have invested a little bit, but I didn't earn it. So that income should not be considered earned income. You see what earned income is here? And notice how it says foreign earned income, right? So it's foreign. It's, overseas. It's foreign. So non-cash income, allowances, reimbursements. And notice what it says here. It says earned income includes amounts paid to you as allowances or reimbursements for the following items: cost of living overseas, differential, family education, home leave, quarters, moving. Amounts not included in foreign earned income: reimbursements, the value of meals. So this is amounts not including in foreign income. So this is not considered foreign income. Payments received after the end of the year following the tax in which you perform services at the end of the income. Amounts included in your income based on your employer's contributions to non-exempt employee taxes. Pension or annuity payments, including Social Security benefits. The value of meals and lodging furnished for the convenience of your employer. So, for example, if your employer gives you, let's say $200 worth of value in food, like let's say a gift card or something, every week or every month or whatever it is, wherever you live, and you also have an apartment there given to you by your job, that's not considered foreign earned income. So look how it says amounts not including foreign earned income, so it's not considered. So that's kind of the difference. And here we have a little example here, but we'll tackle this a little bit later, okay? Let's kind of continue to read this. So who can qualify for this foreign earned income? It says your tax home must be in a foreign country, and you must be one of the following. So your tax home must be in a foreign country, and you must be one of the following: a U.S. citizen who is in a bona fide resident of a foreign country or countries for an uninterrupted period that includes an entire tax year. So what is bona fide or bona fide resident of the foreign country? Bona fide resident just means that you have residency in that other country. So that's one option, okay? A U.S. resident alien who is a citizen, so essentially a citizen, or national of a country with which the United States has an income tax treaty in effect, who is a bona fide resident of a foreign country or countries for an uninterrupted period that includes an entire tax year, or a U.S. citizen who is physically present in foreign country or countries for at least 330 full days of any of the 12 periods. So what this means here is essentially there are classifications to who can qualify for this. In these three circumstances, you're a U.S. citizen, right? Either you're in a country that has a tax treaty with America, you're in a country that doesn't have a tax treaty with America, but you're a resident in either one, or you are just simply outside the United States for 330 days, okay, or more. It says you can use the IRS's interactive tax assistant tool to help determine whether income earned in foreign country is eligible to be excluded from the income reported. And remember, what is the income eligible to be excluded? It's the foreign earned income. It's not the unearned income, it's not the variable income, but it's the foreign earned. So that's the income that we're going to be able to utilize this exclusion for. All right. It says if you're a U.S. citizen or a resident alien of the United States who live abroad, you are taxed on your worldwide income. So this is one of the things about the United States. It actually makes it one of the two only countries in the world right now that currently tax on your worldwide income no matter where you live if you are a citizen. So you're going to get taxed if you live in Malaysia, but you're a citizen of America, you're going to be taxed no matter what. It says here, however, you may qualify to exclude your foreign earnings from income up to an amount that is justified annually. So we talked about what that number was, right? So I think for 2024, like I said, it might be 124,000, 126,000, who really knows? But let's just assume it's 120,000 because that's 2023's number. It says, in addition, you can exclude or deduct certain foreign housing amounts. So remember how we said here, if you earned foreign income, then a foreign earned income, if this is, you qualify for this exclusion, you can get foreign housing exclusion and or the foreign housing deduction. We'll take a look at what that entails. But let's go ahead and read here. It says you might also exclude the income of value and meals, lodging provided to you by an employer. We already talked about that. Other rules. So it says foreign earned income. Foreign earned income means wages, salaries, professional fees, or other amounts paid to you for professional services rendered by you. So if you're a lawyer and you make money living outside of the United States, that's foreign earned income because you're personal services. If you start a business where you're a cleaning service, that's a professional service, right? That's a service. That's foreign earned income. If you make money online and you live outside of the USA, well, that's wages, that's income, that's salary, right? You might not necessarily have a boss, but salary references a boss. Let's say you work for Apple and you do customer support, but you live in Taiwan, Paraguay, Argentina. These are still salaries, right? Those are foreign earned income. And also self-employment income. So if you're self-employed, we used that business idea earlier. So let's say you're a consultant online. Let's say you're a dating coach, right? You're self-employed. You're doing things yourself. You don't necessarily have a company, but you're self-employed. It says here, a qualifying individual may claim the foreign earned income exclusion on foreign earned self-employment income. The excluded amount will reduce your regular income tax, but will not reduce your self-employment tax. Now, what's that mean? Well, self-employment tax is, I believe, at 15% roughly. Don't quote me exactly. I think it's like 15.1 or 15.8, depending on your situation, or is it 15%? I don't know exactly. I might be getting that mixed up, but I know it is 15%, somewhere around there. So what that means is that every time somebody files their taxes currently in the United States who is considered self-employed, when they file their federal tax, they do have to pay tax, based on the tax brackets that they're in for how much they made. But they also have an added tax for being self-employed, which is 15%. That 15% added tax, that self-employment tax, is actually paid to Social Security income, and I believe it's to something else. I think healthcare. I'm not exactly sure, but I know Social Security is part of it for the future. And that's kind of part of it. So there's really no escaping that, right? So even if you live overseas and you have foreign earned income, you're still going to be paying the 15% self-employment tax. You can't really run from that, okay? It says here, not foreign earned income. By the way, Donald Trump was proposing this idea of U.S. citizens not having to pay any kind of tax. This year, he mentioned that this year in 2024, after he got elected, he said Americans could pay no tax whatsoever if tariffs are tariffed at extra 10%. So essentially, anybody who's importing something has to pay an extra, not 10%, but 100%, something like that. What happens is, of course, the United States, everything in the United States will essentially rise in cost, but there will be no tax. You see there? So that's if it happens. Whether it happens or not doesn't, who really knows? But I remember 4 years ago, or maybe even 5 or 6 years ago, Donald Trump said that he wanted to end this worldwide tax approach for people who don't live in the United States. So as long as you don't live in the United States, you don't pay any kind of tax because you're not using the streets and the police services and the fire department services and things like that. And that's what taxes is used for, to pay for these kind of things. But as of now, currently, that's not in place, so that's not something we can really talk about. It says here, not foreign earned income. So what is not considered foreign earned income? Foreign earned income does not include any of the following amounts: pay received as a military or civilian employee, right? So if you're a military person, you go to Korea to do your work there, and you're getting paid by the government, that's not considered foreign earned income. You're not going to be able to take this exclusion. Pay for services conducted in international waters or airspace. Payments received after the end of the year tax following in the year which the services that earned the income were performed. Pay otherwise excludable from income, such as meals, lodging. We already talked about this. This was something we read on the other page. Okay, so let's read this. Your foreign tax home. You may have a foreign tax home if your work is in a foreign country and you expect to be employed in the foreign country for an indefinite rather than temporary period of time. So you don't need to have a foreign tax home if your abode remains in the United States, where you keep closer familial, economic, and personal ties. Notice this part here that says where you keep closer familial, economic, and personal ties. When they create the bona fide residency test, okay, they're not just looking for you living in a different country, right? Because what happens is there are some individuals who do take this tax benefit but come to the United States more than 30 days. Well, how does that work? They look at the familial ties, the economic, and the personal ties. So something that I heard a consultant say before is that if you want to come to the United States for more than 30 days, but you want to take this exclusion, something you can do is you have your family in the other country, wherever you live. You have economic ties, maybe some business, an apartment that you're paying rent for, or a property that you live in, that you're paying a mortgage or something like that. You have a phone bill, you have gym bills, you have things like that you keep records on, so that you can consider it a bona fide residence, right? So that you don't have to, so that if you need to come to the United States for more than 30 days for whatever reason, you can be there and still take advantage of this. That's why over here you have the option, right? You have the option of staying outside of the U.S. for 330 days or more, or right here, a U.S. citizen who is a bona fide resident of a foreign country for an uninterrupted period of time, or simply an income tax treaty who is a bona fide resident of a foreign country. So that's essentially what it comes down to. That's why it says here, familial, economic, and personal ties. Unless you work in a presidentially declared combat zone, most people don't, so we don't have that issue. It says here, figuring the tax. Okay, so let's kind of do a roundup of how far we've got so far, because we read a lot into this. So essentially, the foreign earned income exclusion is contributing to people who live overseas, and that's why it's called foreign earned, meaning you're a property, you're an entity of the United States because you're a citizen, but you earned your income in a different location. And because you earned it outside of the United States, and when we say you earned your income outside, it's not as if you're getting money from a different country. It's that your location is in a different country. You see that? So if your location is in a different country and you're an American citizen, you're making money, you have to, or you have the ability to potentially exclude your income up to a certain amount, right? Depending on what kind of avenue you make that money from. So it has to firstly be earned income. So it has to be either salary or wage, commissions, bonuses, professional fees, and tips. So for example, if you have a property that you own in the United States and you sell it, that is capital gains. That kind of income will not be tax excluded or deducted in any kind of way because it falls in the unearned income category. If you have royalties that you make, like let's say, I don't know what royalties fall under. Let's say you're a book author, I guess, and you get paid in royalties or in rent, rather, right? That's probably better. Or you have a scholarship or something like that. That is not really necessarily deductible. Unearned, variable, earned income, right? So keep that in mind. Now, the only reason why they call this variable income is because these types of incomes are taxed a little bit differently. Like a business profit is going to be taxed a little bit differently depending on if there's a country with a tax treaty or not, and depending on how much money you want to pull out of the business profits, because there are certain countries that tax you only when you pull out money. I believe Hungary is one of them. I believe Bulgaria is another one. So, for example, if you have a business that made $5 million, right, and you pull out to pay and things like that, employees and yourself, you pay out $2.5 million, you'll be taxed on that $2.5 million. The other $2.5 million will not be taxed because it stays inside the account of the business, meaning it was never pulled out. So that's why sometimes it's called variable income. And the United States has tax treaties with lots of other, countries that are overseas, to where you evade the concept of double taxation. And maybe evade is not the proper word that I should use, but essentially you are reducing the concept of double taxation. What is double taxation? Well, if the United States has a contract with, let's say, a country overseas, in this case, let's say Italy. Well, actually, Italy is a specific thing. Italy is very different. Italy gets complicated. Let's use something much more simple, like Hungary. Okay, Hungary has a tax treaty, or Austria, for example, has a tax treaty Austria's better. Austria has a tax treaty with the United States, to where, let's say you owe Austrian taxes. Let's say you live in Vienna. Let's say you owe 25,000 euro. Well, that 25,000 euro can be removed from what you owe to the American government. Because remember, if you live in Austria, if you live in Vienna for 183 days or more, then by definition, you are a tax resident of Austria. So you owe them money no matter what. And depending on what structure you've set up there, ideally, you would have set up some sort of corporation so you can lower the amount of taxes as possible, that you can reduce that tax income, right? So assuming you're not an employee, right? So here, in this case, you can do the deduction in two main ways. The first, and this is the obvious, it has to be earned income. So you can have money from a boss, money from commissions, from bonuses, personal fees, tips, right? That's earned income. Or self-employment income, okay? Self-employment income is income that you will be making yourself, right? Very simple. However, you will still pay the 15% self-employment tax. So let's kind of understand how that actually looks. And we will talk about the home deduction, foreign housing deduction in just a minute. But let's talk a little bit about how that actually looks from a mathematical standpoint. Okay, so let's say you make $100,000 self-employment income. So let's say, for example, you are a graphic designer and you made $100,000 as a graphic designer and you live in Brazil. Okay, I'm not sure if Brazil has a tax treaty with the United States. It probably does, but I'm not sure. But let's say you live in Brazil, okay, for the year. Well, let's say you never came to the United States. That's 330 days, right? So technically, you qualify. Let's say you made the 100,000. Brazil is going to want their tax money. So I don't know what Brazil charges. I have no clue. I don't even have the slightest guess. But let's say you have to pay a fee of, 10%. So you pay $10,000 to Brazil. I'm just assuming. I really have no clue what Brazil charges. But you're going to pay Brazil because you stayed there for 180 plus days. 183 plus days, right? You stay there for the year. When you do your American taxes, right, you're going to look at how much you've made. So you made $100K. Well, technically, that $100K is not actually taxed because it falls under the $120K. So that $100K is not taxed. However, because you're self-employed, you will pay 15% of the $100K, which is self-employment tax, which is a little bit different, right? Now, if you owned a C Corp or an S Corp, which is a corporation, you would technically pay yourself a salary. So let's say, for example, you made $100K. Well, that $100K is being taxed at an S Corp level or C Corp level. That's typically lower than what a normal individual would pay. Let's say it's 24%. So that 100K would be taxed. But however, it's a little bit different because if you're living overseas, the company is based overseas, then you would pay something called a GILTI tax, which is GILTI tax of, I believe, 24% max, something like that. I could be wrong, but you would pay that extra tax, and this is not tax advice, but you would essentially pay the tax for the corporation, and then whatever you pay yourself as a salary would not be subject to self-employment tax. So essentially, you would save that 15%. that's kind of why people do create corporations. A lot of people are curious as to why do people create companies, and do that. It's because they're kind of evading, not evading, but they're reducing their taxes legally by not having to pay self-employment tax. And at a certain level of income, it kind of makes sense, because if you're making, let's just say, $10 million a year, which many people aren't, but let's say you are, from your own personal self-employment, let's say you're a rapper, a singer, maybe you're an entertainer of some sort, who knows, celebrity, who knows, right? YouTuber, some YouTubers can make that. Let's say you make $10 million a year, it probably is a good idea to create a corporation, because just on self-employment income alone, you would pay $150,000 added to whatever you would normally be taxed at. So if you would normally be taxed, federally speaking, because of your brackets at 47%, you would pay $470,000 plus the $150,000, and then on the side of that, you have state tax, you have city tax, right? Which is a lot. State tax could be about 8.5%, and then city tax could be another 4.5%. So that's roughly 13%, 14%, something like that. So you would essentially pay another 13 or 14%, and you would end up that year, out of making $10 million, you'd probably only keep about 1.5 million. If you made 10 million, assuming you made 10 million, it would be 1.5 million for the self-employment, plus 4.7 million, plus another 1.4, so 2.9 plus 4.7. Yeah, you'd pay over, assuming you're self-employed, you would pay well beyond 50%. You would pay probably about almost 75%. Almost 75% of that money would be taxed. So keep that in mind, right? That's kind of important. And people who make income on a very high level, they pay themselves a salary. They have a corporation, they pay themselves a salary that's reasonable, and that reasonable salary that they pay themselves is taxed. However, it's not taxed at the self-employment level, because you're working now under a corporation. I will also add that a lot of people do create corporations for other reasons as well. It's not just for tax purposes, it could be for child support purposes. So let's just say there's a guy who's making $390,000 a year in his own personal business, right? And he's self-employed. He technically doesn't have a corporation, but he notices his marriage is, on the rocks. So what he does is he creates a corporation, and that corporation should pay him different paychecks every single month. And the paychecks should be relatively stable. Let's just say $390,000 a year he's making, which turns out to be, I think, I don't know how much that is per month, but let's actually do the math on that. Let's figure that out right now. 390K divided by 12, that comes out to $32,500 a month. That $32,500 a month, let's just say he pays himself a salary of $6,000 a month, okay? Well, that extra money, which comes out to $26,500, sit in the corporation. That corporation would be taxed based on the 26.5, but the $6,000 he pays himself every month would be multiplied by 12. It would come out $72K. He would not pay self-employment tax on that, because he's not self-employed. He's employed by a company, which happens to be his own, and that $72K would be taxed, right? Normally, state tax, federal tax, city tax if he qualifies, but more importantly, he would be taxed completely on that. But he has a pay stub now showing that he's making $6,000 a month. So when his wife takes him to child support court, and he shows that for the past 2 years, he's been getting a paycheck of $6,000 a month, what happens? The judge should look at that number and say, okay, child support is 17% per child, let's say, per one child. 17% of $72K is $2,000, so he'll be paying roughly $2,040 a month for that one child, assuming that he's going to be completely covering the care. The mother could whine and yell and scream and cry that he's making much more money, and he could be, but it's, like I said, in a corporation. So in that kind of way, it's protected. However, there are some judges that don't really pay attention to those kind of things. But hopefully you guys enjoyed this video. Hopefully this video helped. I want to talk about in the future different countries that you could spend time in to reduce your taxes significantly. So, and not just taxes, but expenses, getting rich, things like that. So hopefully you guys enjoyed this video. I'll talk to you guys soon, and thank you for watching. Peace out. Bye.